The reason why I expect the dollar to weaken is because the Federal Reserve is going to cut interest rates more than other central banks, because the Fed has lagged behind other central banks this year, so it's got some catching up to do. So I think the Fed will cut rates 4 times in the next 12 months, whereas the ECB, most will cut interest rates once.
Die Geldmeisterin. Der Finanzpodcast mit Julia Kistner.
Yes, very welcome at Geldmeisterin again on my podcast channel, Mr. Paul Jackson.
Lovely to be here.
Before we start with a big picture for 2026, I would like to start with the top 10 of the surprises you have for the year. So could you give us some ideas what surprises you most in 2025?
Well, I think it's been a very good year for investors. So investors should be happy. Most assets have given positive returns. In terms of the surprises that I predicted at the beginning of the year in my list of 10 surprises, we don't know all of the answers yet because the year hasn't finished. But the most important prediction did come true, and that was that Europe would win the Ryder Cup. So that's a bit of good news for everybody in Europe. But the dollar has weakened. US stocks probably have underperformed in dollar terms, in common currency terms. But we need to wait to see how the other predictions work out. But it's been a very good year, I think, for most investors.
Mm-hmm. So what will we take then for the forecast for 2026? You think that the global economy is expected to accelerate. Why do you think so?
Yeah, I think there are a number of things that will cause the global economy to accelerate. First of all, interest rates are falling, and they've been coming down in most countries for maybe 2 years now. And so that's probably going to continue in most places. Not so much in Europe, because I think the ECB has already done most of its work, the Swiss National Bank also, but the Federal Reserve in the United States, the Bank of England, and a range of other central banks are still cutting rates. So I think that will help economies. And linked to that, money supply growth is picking up in many places. So we can see that monetary expansion is coming through. We also have fiscal expansion coming through in some places, particularly Germany, with spending on military and on infrastructure. In Japan, there's a new budget going to be announced by the new prime minister that looks as though it could give a bigger than expected fiscal boost in Japan. The numbers that they're talking about could be as big as 3% of GDP, which is enormous. But I don't expect all of that to be in 1 year. And in the United States, where at the moment that there's not really an impulse that is programmed, but Donald Trump has started to talk about offering everybody a $2,000 bonus.
Yeah.
And you know, whether he can do that or not, I don't know. But if that were to happen next year, that could be something like 1, maybe 1.5% of GDP. So even in the US, you could get that fiscal bounce. And don't forget, in the United States in 2025, they have taken a lot of actions that have depressed the economy.
But do you think that, for example, the tariffs are already through, or will we see bad things from the tariffs and status next year also?
This was my point, that they've done a lot of things that to handicap the economy this year. So the tariffs have handicapped the economy, the closure of some government departments earlier in the year, the forced deportation of people, the government shutdown. They've done everything they can to depress the economy. And if some of those things just don't happen, if they're not repeated, then the economy probably will be better next year. And real incomes are growing in most places around the world. On the tariffs, it is interesting because the Supreme Court is currently deciding whether the tariffs are legal or not. And they seem to be leaning towards a decision that the tariffs are illegal, in which case the tariffs would have to be removed. And that would be good news for everybody. That would be good news for everybody.
So from the side of the tariffs, you think more positive surprises than negative?
I don't think it's going to get any more negative.
Mm-hmm.
And it is possible, we don't know what the Supreme Court will decide, but it is possible that they may say you didn't have the right to impose these tariffs. And if that's the case, then the tariffs have to be removed. The money has to be given back. And the US economy, I think, would be in a better place, as would the global economy.
Mm-hmm.
I was going to say that even without that,
Mm-hmm.
I think the global economy will improve.
Mm-hmm. That sounds good. But one message is also that the dollar will weaken again. Is this already a matter of trust? If you say for example, if he spends $2,000 for each American, then this won't be very good for the dollar either. Huh?
I think it could go both ways.
Yeah.
The reason why I expect the dollar to weaken is because the Federal Reserve is going to cut interest rates more than other central banks, because the Fed has lagged behind other central banks this year, so it's got some catching up to do. So I think the Fed will cut rates 4 times in the next 12 months, whereas the ECB at most will cut interest rates once. So US short-term interest rates are going to come down more than elsewhere. In Japan, they're going to go up. So I think the dollar will weaken because of that. Now, on the tariff question, on the tariff, that $2,000 question that you mentioned, the impact could be to strengthen the US economy because everybody's got more money in their pockets. So, and if the economy strengthens, then maybe the Fed cuts rates less than it would have done, so the dollar may not weaken as much. But there could be the other side, which I think you were thinking about, which is that perhaps bond yields may go up because the markets don't like the increase in debt. So bond yields go up at the same time that the dollar weaken. And so if the markets view that giveaway of money as a negative thing because of what it means for debt, then yes, it could weaken the dollar, but I could see reasons why it may strengthen the dollar as well.
Mm-hmm. And you said that inflation is no longer trending down and may rise. So why will the real income then go up if the inflation also goes up?
Yeah, well, for the moment, real incomes are rising in most places that I look at, and I'm not expecting inflation to jump higher. What I would say at the moment is that I think inflation in most places is flatlining, but the risk is clearly that it could go up a bit. And if economies strengthen, then I would expect inflation to rise a bit. But at the same time, if economies are strengthening, I would expect wage growth to go up as well.
Okay.
So the two would go hand in hand, I think. And so we've still got rising real wages, and I suspect we still will have, even if inflation picks up a little bit.
And you say yield curves will steepen for 2026.
Yeah.
How much and why?
Probably more in the United States than elsewhere. You get the Fed rates coming down 100 basis points. So that gives you some steepening if there's no movement at the long end of the curve. But I suspect that those 10-year yields in the US could actually rise a bit. So the steepening of the yield curve will be more than 100 basis points. You get a 100 basis point reduction in Fed rates, and then maybe a little bit of, maybe say a 25 to 50 basis point increase in the 10-year yield. So you might get something like 125, maybe 150 basis points of steepening in the US. In the Eurozone, it's going to be nothing like that because ECB rates won't go down very much, if at all. And if the 10-year yields in Europe go up a little bit, you're going to get a little bit of steepening, but it might be 25 to 50 basis points of steepening in Europe. In the UK, the Bank of England needs to cut rates more than the ECB, so there will be more yield curve steepening in the UK than there will be in the Eurozone.
You also say that the projected return suggests a barbell approach. Could you explain this a little bit? What do you mean with that?
Yes, so a barbell is this idea of when you're lifting weights, you've got the weights at either end of a bar. So it's the idea of, it's been a long time since I've lifted weights, so I've almost forgotten what it is. But in terms of the investment returns that I'm talking about, if you think of the volatility spectrum, so you've got the low volatility assets, things like cash, AAA rated CLOs, bank loans, they're all low duration, low volatility. And at the more volatile end, you've got cyclical assets such as commodities, REITs, equities. So what I'm expecting is that the best returns will be on something like commodities, because if the global economy picks up, then that should increase demand for industrial commodities like energy and industrial metals. So I'm expecting the best returns at the most volatile end of the spectrum. Also good returns on REITs, good returns on non-US equity market.
On which one exactly? On
a range of them, but particularly China. China has done very well in the last 2 years, and I think there's still scope for the Chinese market to do well. I think Japan will do well. Europe, I think it will do better than the United States, but I wouldn't necessarily choose it as my favorite market. But non-US equities, there's a volatile asset category. And so I think all of those volatile assets will do well. They'll give you good returns. But at the more defensive end, the interest rates available on cash, on AAA rated CLOs, on bank loans, those interest rates are higher than usual. And the spreads on something like bank loans are in line with historical norms. So you're actually getting quite a good rate of interest, quite a good yield at that very conservative end of the spectrum, better than you're getting in the middle ground on things like government bonds and investment grade credit and even high yield. You're getting better yields on bank loans than on high yield. So that gives me that barbell thing where I like the very defensive assets and I like the riskier asset.
And where do you put the tech investments or the big tech then in which part of the bar?
They don't appear in my bar. They would be, because of what I think are quite high valuations. They're clearly, and we've seen in recent weeks, they are quite volatile. So they're at that more volatile end of the spectrum. But what I do, you remember, I was very careful to say non-US equities, because I think the US market is expensive. It is also very concentrated in those big stocks. And my concern is that something can happen that brings down those expensive mega cap stocks, and that causes the US index to suffer. So if I'm investing in the US market, I prefer to be equally weighted rather than market capitalization weighted. So that puts more emphasis on smaller and mid-cap stocks. Also, I would be more selective. I like the banks sector because banks in the United States outperform when the yield curve steepens. And we do have the promise of deregulation. And it's the same for UK banks as well. But within the US, though, those banking stocks, the metals and mining stocks, which have done very well this year because of gold, I think that they will do well because of the industrial metals next year, same as energy stocks. Industrial stocks in general, particularly in Europe, actually, but if we're talking about the US, I would look at things like banks, metals and mining, and industrials because of the expected pickup in the economy. So I would focus on those areas rather than on those mega cap stocks.
And you just were talking about industrial metals, not precious metals. Are they also not on your bar?
The I mean, gold has done so well and silver is now doing well. Gold has done so well this year, but it's done so well over recent years that the price, I think, is now very high.
Mm-hmm.
And if you look at it in real terms, it's nearly 4.5 standard deviations above the historical norm. It is at quite an extreme point. That doesn't mean that it can't go higher, but it's already gone up a lot. And the gains that we have seen this year have really only been exceeded in 3 years since 1970. That's 1973, 1974, and 1979, when inflation was a lot higher, when the gold price had just been liberated. So it was a very different environment, and that's the way that gold has been performing recently. So when I look at the price of gold and the valuation of gold, it makes me a bit cautious, accepting that gold is very good when there is a crisis, and there are many things, if there's more inflation or if we start to really worry about government debt levels, then gold is a good asset in those circumstances, but it is expensive. Whereas when I look at industrial metals, things like copper, aluminium, those metals in aggregate are very close to their historical norms in real terms.
Mm-hmm.
That's also the case for energy.
Mm-hmm.
So I feel more comfortable with those sorts of commodities, especially if the global economy is going to accelerate.
Mm-hmm. And so, since you don't like US shares, or most of them, is the reason that you also strengthen that strong performance runs rarely go beyond 3 years, or does this also belongs to other markets, or is this just especially in the US the case?
It is particularly the US, because the US market has been outperforming since 2008.
Mm-hmm.
I mean, everybody thinks that the US market always outperforms, but that's not true. But it has been outperforming on a trend basis since 2008. And if you go back to 2008, in the way that I look at it using cyclically adjusted PE ratios, the US market in 2008 was cheaper than Europe, it was cheaper than China, cheaper than emerging markets. Now, after that outperformance, it is much more expensive than any of those markets. The cyclically adjusted PE on the US is now something like 44, 45, whereas in China it's around 17.
Mm-hmm. Okay, so that's a difference.
In Europe, it's in the low 20s. So the US has gone from being a relatively cheap market in 2008 to being a really expensive market in 2025. So it is in a very different place to most other markets, but it is driven to a large extent by a limited number of stocks within the US market. And that's why I say if I would prefer to invest on an equally weighted basis, because that then dilutes the exposure to those limited number of stocks that are really expensive.
Altogether, you just see signs of a coming improvement, a macro improvement, I guess. What are the leading indicators which show you this improvement?
First of all, if you look at things like PMI indices around the world, that they've been improving. So purchasing manager indices have been improving. Leading indicators themselves, leading indicator indices have been improving. And in fact, across the countries that I look at, most countries, their leading index is above trend, and it's been improving in the last 3 to 6 months. And a leading index is supposed to tell you what's going to happen in maybe 6 to 12 months' time. So that suggests to me that there is improvement coming.
And what could be the surprises from President Trump then, since you think he needs something big in 2026?
Well, the surprise would be if there were no surprise. Really, that really would be a surprise. I always used to say to my children, that they would say, "Have you got me a surprise?" When I've been traveling, I say, "Well, the surprise is there's no surprise." But that would be true in the case of the US. So I think, yes, we have the midterm elections in November of 2026. Typically in a midterm election, the party of the president loses seat. So it's not a presidential election, it's just an elections in Congress. And at the moment in Congress, there's a very tight majority in the House of Representatives. The Republicans have 219 seats. They need 218 to have a majority. So they can't afford to lose many seats. But if you go back historically, it's literally every midterm election since 1938, the party of the president has lost seats, with two exceptions. The second term of Bill Clinton and the first term of George W. Bush. And those two presidents at that time were very popular. Their approval ratings, net approval ratings, were above 60%. Donald Trump's net approval rating is around 40%. So he's in a very different position to where they were. And recent elections in the US, New York City, Virginia, New Jersey, suggest that we are getting this midterm swing towards the Democrats and away from the Republicans. So that suggests two things. First of all, 2026 may be the last chance for Donald Trump to do what he wants. Because if the House of Representatives becomes Democrat, he can no longer do what he wants. So it may mean that 2026 will see a flurry of activity again from the president, but also he may try to do things like the $2,000 bonus to try to persuade voters to vote for the Republicans. And so he may get more and more desperate. He may also try to do things which can wing the electoral arithmetic, things like the redistricting in Texas, which, by the way, has been ruled illegal by a judge there. So it's not clear that they're going to be able to do that now, but he may try to do things that could change the electoral arithmetic. He may try to effectively bribe the electorate, and that could be good or bad, because as we were saying earlier, it may support the economy. If he tries to do things in terms of the electoral system, then that could get a little bit volatile. But at the end of the day, if he's got big things that he still wants to do and to achieve, then 2026 may be the last chance. So 2026 could be still a very active year in terms of US politics. And again, that could be good, it could be bad.
And what can the investor do then if you go back to your 12-month projection and favoring the barbell approach? Is this how the US allocation also looks like, or what should the investor do? What are your suggestions?
Yeah, I think, as a house, we feel that non-US equities are probably more attractive than US equities. So if you're concerned about that situation in the US, then we're already saying that we prefer non-US markets. And yes, in the US markets and assets such as bank loans, you are still getting a good rate of interest, and there's a normal spread versus cash rates, and you add those cash rates, the Fed's rate is still 4%, you add a spread of around 3% to that, and you're still getting a good interest rate on an asset category that has proved to be relatively defensive, more defensive, less volatile than government bonds, less volatile than investment grade credit. So it usually is a relatively defensive asset, and you're getting an interesting interest rate. So I think the recommendations are similar, but also to what I was describing at the global level. But also, as I was saying earlier, maybe just be a bit more selective in the US. Things like the bank sector, I think, is good if you're looking at things like value and size, so small caps rather than large caps, looking for that improvement in performance from small cap. So I think you just got to be a bit more selective, but also look outside the US as well for opportunities.
Mm-hmm. And do you think, since the data centers and chips have to be financed, that bonds could outperform shares next year?
Well, in the global projections, we're expecting shares to do better than bonds. So it's kind of like an upward sloping relationship between volatility and risk. In the US, because of the valuation of the stock market, I think it's more delicate balance. So the balance between, say, government bonds and equities, there may not be such a strong preference for equities as I would have, for example, in the UK or in Europe. I would have more of a preference for equities rather than government bonds in those markets. But in general, globally, I would expect better returns on equities than on bonds.
Mm-hmm. And since Chinese equities are the darlings again, is it a cause of Tina? There's no alternative? Do you really see there's so many opportunities? And what about India?
Well, I think India was more expensive than the US 2 years ago, but it has come down, but it's still expensive.
Mm-hmm.
So it's not as expensive as the US. The US has gone up, India has come down. So India is still well above historical norms and still a long way above somewhere like China. There is probably better economic growth in India, but economic growth doesn't always correlate with stock market returns. And in fact, what is quite telling is that since 2019, the GDP per capita growth in China has been superior to that in India. So although India has grown more rapidly, the productivity growth in China has been stronger, which I think is a good sign. Within the Chinese market, and by the way, I was in Asia last week. This week that has just passed, I've been in Europe. I've been spending time traveling around. I would say that investors, when it comes to the Chinese market, 2 years ago, they were not interested. They did not want to think about investing in the Chinese market. Now there is more openness to that, but I don't think that the international investment community has put a lot of their portfolios into China. I think it's been driven more domestically than by the international market. So I think there is still an adjustment that could be made by international investors. But of course, the Chinese tech sector has now become very interesting. Everybody's interested by it because it's been outperforming the US tech sector over the last 12 to 15 months. It is cheaper than the US tech sector. And, some of those tech companies in China are competing and out-competing the US counterparts. So it is an interesting sector within what I think is an interesting market.
Mm-hmm. So at the end, what are the main chances or opportunities and risks for 2026, you think?
So I think the main opportunity comes from that economic upswing, falling interest rates and so on and so forth. So that economic upswing usually, historically, has been associated with better returns on cyclical assets. So I think that's the opportunity. The opportunity for the best returns is going to be at the more cyclical end of the spectrum, things like commodities, REITs, non-US equities. But the good news is that you can diversify that volatility with the low volatility stuff without giving up on returns. So that is good news. The risks are, first of all, yes, we've had 3 years of good returns across assets. So is it possible that we're now going to get a 4th year in a row? We think so, but the longer that this goes on, this strong performance, the less likely it seems that we will get strong performance in the future. And the obvious things that could upset financial markets would be if we don't get an economic upswing, and if instead we get recession, and typically recession is something that is associated with better performance by things like government bonds, gold, the more assets that are considered to be more defensive. And the longer, when you're in recession, yes, you don't get volatility. Cash gives you no volatility, but it's zero duration. Whereas if all interest rates are coming down in the recession, then you want the government bonds, you want the investment grade credit, because there you've got duration and the duration works in your favor. The other risk is, if inflation picks up more than we expect, and there are very few asset categories that like inflation. So a tendency towards more inflation, if it's associated with stronger growth and it's being caused by the stronger growth, it's maybe okay. But if the inflation is going up just for no reason, then I think that would be a negative. But overall, the main risk is always that we're wrong.
Yeah.
That's the main risk that we face.
But I'm sure you're not wrong, but I will check and we will talk to each other next year again.
Okay. All right. Well, fantastic. It's always good to speak to you.
Have a nice evening.
Okay. Bye now.
Bye.
Alles Gesagte ist nur die persönliche Meinung von Julia Kistner und daher keine Anlageempfehlung und keine Rechts- und Steuerberatung. Für Verluste, die aufgrund von getroffenen Aussagen entstehen, übernimmt die Autorin Julia Kistner keine Haftung.